This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning John Rubino, well-known author and publisher of the website dollarcollapse.com. Good morning, John, and welcome back to Macro Analytics.
Morning, Gord. Nice to be back.
Well, I hope you're having a good summer. I know you had a little bit of a vacation and got to do a little traveling, I noticed in one of your articles.
A little bit of traveling, yeah. Not nearly enough, though. Summers are beautiful out here in Idaho, and if I could live my life exactly the way I'd like to, I would take entire summers off. Just work in the winter. It doesn't work that way, though.
No, unfortunately, life doesn't allow that until we get a little older and have a little bit of retirement time to do that. John, we haven't had a chance to talk about Europe between the two of us in quite some time, and I thought this morning this would be a really good time to revisit what's going on in Europe, specifically with the capital flight and bank runs. And I know you've been warning for some time in some of your writings that you thought that capital controls were around the corner if, in fact, money started to leave Europe. What are you seeing? I have up here a chart that shows the Target 2 accounts, which has just been dramatic of the amount of money that's been going from the peripherals to the core, from the charter banks or the commercial banks to ending up with in the German banks and then flowing around in a circle. And this system has worked, but now the money is in fact leaving the country, or leaving Europe, the EU, which is going to cause a whole raft of new problems. What are you seeing and what do you feel is going on?
Well, what's happening now is the ECB and Germany are pouring money into the periphery countries to keep them from imploding. And this works in its first step. You know, the money flows into the Spanish and Italian banks, and that gives them enough capital to survive for another day. But what's happening is the private sector. Individuals with deposits at these banks are pulling their money out and moving that money to what they feel are safer environments like Germany and Switzerland, and outside the Eurozone completely. And so basically the bucket has a hole in it now. So the money is flowing from the ECB into the peripheral countries, but then leaving the Eurozone completely. And that means that no matter how much money, how much new credit that the ECB creates, it's not going to be enough, because nobody in their right mind wants to maintain a bank account in Spain or Italy, because they see some kind of trouble coming, either capital controls or their country leaving the Eurozone completely and going back to pesetas or lira or whatever, and at a big discount. And so completely rationally, they're moving their money out of the system. And so we've reached a point now where they're on a treadmill and they're running faster and faster and creating more and more cash and throwing more and more cash into the periphery banks, and it's not working. And so the next stage of this really is some kind of capital control, where Italy, say, just tells its bank customers that they can't take money out of their accounts anymore, or creates some other kind of rule that prohibits the movement of capital outside of the country. So, in other words, they're going to try to fill in the holes in the bucket, and that's going to create far more problems than it solves. But that'll be the next step, because panicked governments always move in this direction. When they see money moving out of the country, they try to stop it. And there are a dozen different kinds of capital controls that have been used in the past and that are being used around the world right now. And so we'll see the Eurozone countries probably try some of these in the not too distant future. You know, the Eurozone announced a while ago that they were considering capital controls, including limits on withdrawals from bank accounts, if Greece imploded. And Greece didn't implode. They were able to save Greece, at least temporarily, but they have not been able to save Spain and Italy And so for one of them to blow up, you would see the same thing imposed, possibly across the whole Eurozone. And that would really change everything. If all of a sudden you can't move your money across borders, then so much for the free market. The euro project will have collapsed, and we're really looking at the very real possibility of that sometime in the coming year.
I don't see any way around it. I'd be really clear here, John, personally, that I believe that the restrictions will be of taking money outside of the EU. It won't be of taking the money out of Italy if, in fact, it's going to Germany. I know they don't want to do that, but right now the Target 2 and et cetera has allowed it to work. I think it would cause too many problems. It's actually leaving the EU that they're going to have to stop it. I have a chart up here now that for our listeners that may not fully be aware of the magnitude, and the chart I'm showing this is Singapore. And you can see that the money is just starting to really flow into Singapore. And the next chart I have shows Switzerland, which is even more dramatic, both of these being outside of the EU. And I don't believe that it's unique to these two countries. Certainly, up until recently, the United States Treasury and the dollar strength has been attributed to money flowing into the U.S. bucket, whether for dollars or for treasuries. But there's more than that. I've seen it in other countries. I just don't have the statistics here. But John, I saw the other day, and I'm sure everybody in the ECB picked up on this, that Shell Oil announced that they were moving their money out of Europe. They were only going to keep cash available for general operations, and it was in the area of $6 billion of operating cash they completely removed outside of the EU. And the fact that they even were public about it, because I know that this has been going on, and usually chief financial officers are very quiet about this, but they won't even risk it sitting at the Deutsche Bank.
And this is all completely rational. Europe is entering a really unpredictable stage. And so if you've got cash, the most reasonable move, especially if you're a fiduciary, your job is to protect your shareholders or your clients. The most reasonable thing to do is to get your cash out of this unstable situation and into the most stable possible place. And Switzerland, Singapore, places like that are vastly better run than the Eurozone is right now. And so obviously lots of money is flowing into those places and out of the Eurozone, but that's also unsustainable because Switzerland is a small country, and they're seeing their foreign exchange reserves that are denominated in euros explode right now, which in effect means they're having to place a gigantic bet, a long bet on the euro. They're buying euros, in effect, investing in euros. And for them, that's a bad deal at some point. And their central bank is now threatening capital controls to keep euros out of the system. And they're also threatening dramatically negative interest rates, which means if you deposit euros in Switzerland, you don't get paid for that. You have to pay them in order to hold your euros. And same thing with Singapore. It's just not in their interest to accumulate too many reserves denominated in foreign currencies that are not well managed. So, we'll see these guys at some point try to slow down and maybe stop the inflow of foreign currency. And it's one more step in a world that's becoming extremely unstable and in which there are fewer and fewer safe havens. The U.S. is the next in line. I mean, we're going to negative interest rates too, so that if you want to cash out of euros and buy treasury bonds, you actually have to pay us for the privilege. And that is crazy on so many levels and unsustainable on so many levels that it won't last. The old saying, if something can't go on, it won't go on. And a negative interest rate world is the quintessential situation that can't last for very long.
This might be the death nail here, as the capital is now leaving the EU, because if you just pick on Spain here as an example, the banks are already teetering, if not in fact insolvent. They've had the bailouts, but we have bad non-performing loans now also starting to go ballistic, fundamentally because of a collapsing real estate and high unemployment in Spain. So you take that, and then you have people pulling the money out of the bank accounts completely. And it says, well, before they could get around it by basically what I refer to as Ponzi bonds, and that's a long discussion of how that little gig is working with the ECB and the country's central banks and the country itself, in fact, guaranteeing the bonds as they floated around. But they're running out of collateral, and they can't do it. So any of this money fleeing in a reserve system now, it's becoming, there's no way they can replenish it into these banks and keep them solvent. And the other thing, John, that I'm really seeing, and we all know that in Europe, well, banks lend long, but they borrow short. And in Europe, they've used money markets to such an extent as the lending source. And so as rates have come down and money markets have dried up, the duration of all of the European bonds by the sovereigns, specifically in Spain and Italy, have got shorter and shorter and shorter. And I have some charts here that show it even in France and Germany. So that next year, 2013, we have the mother of all maturities walls that we're going to hit. And so when these bonds roll over, it's going to be, well, what's the real value of them, the collateral, the bills rather, the collateral of it, and there's going to be enough money to allow them to roll over. And the answer is there is not going to be. And the Litros made a big difference to some of it, but with money being pulled out of the system, I'm not sure what rabbit, other than just out and out printing, the ECB is going to come up with.
Well, that's the next thing that they'll do, obviously, is just open the floodgates. They'll print as much as it takes and announce that they're going to do it in order to keep the Spanish and Italian banks from imploding. But, as we talked about, the bucket has holes in it. And so they can pour infinite amounts of newly created euros into the system. But if they aren't blocking the outflow, then that money is just going to flow to safer havens until the safer havens stop accepting any new money. So at some point, the flow has to be forcibly stopped. Either Switzerland, Singapore, and the U.S. just make their interest rates so negative or impose other kinds of controls on capital inflows, or the Eurozone countries impose controls on capital outflows. This process that's engaged now will continue. But once we go to the point of capital controls all over the world, then global trade ceases to function in the way that it has in the past 30 years. We end up with a system where nobody knows what the future is going to hold. Nobody knows if they invest in one country, whether that country is going to change the rules in some way that locks up that money for 6 months while the market is moving in an unfavorable direction. You just won't know. And so you'll see capital become so terrified that the risk on trade just dies, and we go to risk off. Everybody's just trying to be safe. Nobody wants to invest in anything positive about the future. They're just they're focused on return of capital instead of return on capital, and that's a death knell for a system that requires growth going forward. Because if we we end up with a global recession, which is what you would get in that kind of a scenario, then all this debt we've taken on becomes more and more onerous over time as the global economy shrinks, and we fall further and further behind on our ability to keep up with this debt, and we drift into a global depression. And that's what the central banks of the world are looking at. And I suspect that they're discovering that there's no solution to this. There's no way to fix this much debt. And so they're going to try patch after patch after patch until it all fails. And, the question then becomes timing. When does it fail? When do we try the last, fix that doesn't work? And when do the markets figure out that is the last fix? And then everyone panics. And, as we talked about before we started recording, it's no way to know the timing here, but the outcome is becoming more clear every day.
The failure is clearly on the horizon, but I don't believe, John, that it's imminent, though the market itself is sending some incredible signals here being very much overextended on no volume, small VIX, and all algo traders that are going on. But we've never seen a time in history, and we've seen enough currency wars that go on. But our country uses competitive devaluation. But in terms of Europe or even anywhere where they've got no choice but to increase the monetary base or to use the word print money to do it. So they can't. They usually hide behind currency devaluation. And this time they're not even going to hide about it. They're going to be quite blatant. But at the same time, we've never had negative real rates around the world stopping the capital flows. So they've got a real push and a shove. So it says, well, where's the money going to go? Because I believe the smart people are already figuring this out and moving it. And I know that for a fact they are. And I noticed, and I need to point out, George Soros and Paulson were making some pretty public statements here this week where they're out of equities. They've moved out of financial instruments. I believe they were also talking bonds, but the quote was specifically equity. And here's what also caught my attention. They're buying gold for the first time. They're now increasing their positions in gold. And it's just the simple fact that these kind of people are looking for alternative solutions tells me that we're in the final end run here. Now, this end run could last 12 months or 14 months as we get more and more escalation going on, because money velocity is still plummeting. It's not rising, and that's usually your first sign of going to things like hyperinflation. So we're getting a lot of canaries singing pretty wildly right now.
What's interesting about this time is that the surface statistics and sense that you get out there by reading the newspaper is not horrendous. It's kind of mixed. The global economy is slowing down a bit, but the numbers are still generally positive. And inflation is low, and unemployment is kind of stable. It's not coming back, but it's not depression level when you look at the main number that governments use. And so you could get the sense that things are not great, but not deteriorating. But if you look below the surface at the kind of stuff that we're talking about, especially the charts that you're showing, you see us heading off a cliff. The fundamentals are deteriorating at an accelerating rate around the world.
Well, there's no question about that, John. The earnings are plummeting. We have a hockey stick to even make the 2012. We've got currency headwinds in some of these cases. But we've been playing a game of manage perspective economics, and that is the dramatic distortions that we've got in inflation, as you just mentioned, and growth. And you mentioned whether we'll see a global recession. John, a global recession is defined if the global growth is less than 3%. Well, right now, the IMF politically has got it just marginally above 3%, but are screaming warnings, which is a very clear sign that they believe it's less, but they're not ready to make the statement. And the World Bank just came out and announced it's 2.5%. So that is, by definition, a global recession. And John, that's based on a deflator of 1.8. That's ridiculous. The deflator should be well north of 3 to 4.5 minimally. So what we've got is distortions of the numbers. So the situation, the slowing is much worse, and that's very, very clear in the ISM and the PMIs. And what's going on in China, I see it in the Baltic Dry Index. I see it in copper stockpiling, etc. So that the slowing is there, and what this means is cash. Cash is being drained from the system because it's not being replenished by wealth creation.
And you wouldn't get this from the headline numbers.
Not at all. Not even close.
In part they're lying, and in part the fundamentals haven't hit some of these headline numbers yet, but they will. I mean, the trends are all off a cliff when you look at the real statistics that actually predict what's going to happen. And so the next year should be fascinating, because we'll reach a point where even with distorted government statistics, it'll be clear that things are deteriorating at an accelerating rate. And it'll be very interesting to see which tools the government pulls out next when they really start panicking, because back to capital controls, that's one possibility, or just massive reflation where the Fed and the ECB and the Japan Central Bank all say, look, whatever it takes, we will supply the system with as much liquidity as it needs to get back to normal. And then at that point, that kind of opens the floodgates for people who want to short long-term government bonds and buy precious metals. It seems like that becomes the only possible strategy, and you'll see everybody pile into it. And that's coming out there somewhere. And so 2013 should be one of the years that historians look back on and devote whole chapters to in their books about this century.
The Fed has got a number of papers out. It's working on the impacts of limiting shorting in the market. That tells you when they start to spend their time doing this kind of research, the issues. There's a huge amount of discussion going on and changing the whole basis of money market funds, that they're not based on $1. They're going to be NAV based, and a few other changes that are being made in there. And people like federal money markets are just screaming that this is what it's going to mean to the world market. So, and which is just more financial repression as they force negative rates to stop these flows. John, we're up against our hard line. Time goes by so quickly, and it's a huge subject. We're just the tip of the iceberg here, but I really mention to our listeners, or suggest to our listeners, that watch really closely with this issue with these bank runs and capital flows, because this is a driving factor. John, any last comments you'd like to make?
Yeah, Gordon. The things you just mentioned, bans on short selling and changes in the structure of money market funds, these are going to be presented as positives for the market when they're imposed, but they're really obviously signs of weakness. This is a sign of a government that has completely panicked and is now doing its best to distort the decision-making process of people within the market. And I think most market participants are going to see this for what it is, so that when they're imposed, money is going to start flowing out of the system in which these things are imposed at an accelerating rate. So you might get a pop for a couple of days when the government comes in with one of these new rules that they promise will fix things. But the reality will reassert itself really quickly, and we'll see an acceleration to the downside when they really start imposing capital controls.
John, could you tell our listeners how they could learn more about your website and the work that you do and your writings and the things that you're working on?
Sure. I run dollarcollapse.com, which is a site that's dedicated to what we've talked about here. The idea is that it's a daily updated site in which you can visit for an hour in the morning or an hour in the evening and basically be caught up with all the dark side of the global financial system.
John, we're going to be back together in a couple of days, and we're going to pick up on some of the things you spotted on your vacation that I mentioned earlier. So I'm looking forward to that. So until then, talk to you later.
Great. Thanks, Gordon.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.